Hey everyone, welcome back to Corporate Decoder, the place where we decode complex company filings so you don't have to. Today we're diving into a report from QXO Incorporated, a company that's making some big moves in the market. It looks like they just sold a ton of stock, which is like selling slices of their company pie. Was it a good move, or will it leave them with a bad taste? Let's find out. Before we dive in, if you appreciate getting straightforward insights from corporate documents, make sure you're subscribed and hit the notification bell so you're alerted every time we have a new video. Also, we have a Discord community linked in the description below where you can discuss these filings with other investors and enthusiasts. This report is called an 8K, and companies file these when big things happen like a major agreement or event. In this case, it's all about a big stock sale that happened in May. The main event is an agreement called an underwriting agreement. Think of this as QXO hiring a team of experts to help them sell a large chunk of their company's stock to the public. The experts in this case are Goldman Sachs and Morgan Stanley. Basically, QXO made a deal with these companies to sell a whole bunch of their shares to the public. QXO sold over 48 million shares of their common stock, which is just a fancy way of saying regular company stock. The price 16 per share. It is worth noting that they have another almost 733 million shares available if the underwriters decide to fully exercise. After the underwriters fully exercise, they expect to get approximately $892.8 million comfort though. I think the underwriters decide to fully exercise. After the underwriters expense to get approximate size, after the underwriters fully exercise, they expect to get approximately $92. That's a lot of money, but keep in mind it's after paying the people who helped them sell the stock and covering other expenses. This agreement also includes some standard promises and guarantees from QXO. They're promising that the information they're giving to investors is accurate. It also says that the company will protect the underwriters from certain risks. Basically, if something goes wrong and the underwriters get sued because of the stock sale, QXO will help cover their costs. This stock sale was done under something called a registration statement, which is a document companies file with the Securities and Exchange Commission, or SEC. It's like getting permission from the government to sell stock to the public. If you're really curious, you can find the full underwriting agreement as an exhibit attached to this report. It's got all the nitty-gritty details. Besides the agreement itself, QXO also put out a press release to announce the stock sale. A press release is like a company's official announcement to the world about something important. You can find a copy of that press release attached to this report as well. It's their way of telling the public about the stock sale in their own words. Lastly, there are some exhibits attached to this report. These are extra documents that provide more information. For example, there's a legal opinion about the stock sale. Now let's step back and look at the bigger picture. QXO just brought in a lot of cash by selling shares of its company. This could be a smart move if they use the money to grow the business, pay off debt, or invest in new projects. However, it also means that existing shareholders now own a smaller piece of the pie. Their ownership has been diluted, which could affect the stock price. QXO is betting that they can put that money to good use and increase the company's value in the long run. So what does this all mean? QXO has made a significant financial move by selling a big chunk of stock. They now have a lot of cash on hand, but they also have a responsibility to use that money wisely. Investors will be watching closely to see how they use this new capital and whether it leads to increased growth and profitability. Here's my take. QXO's decision to sell stock makes sense if they have a clear plan for growth and can use the funds effectively. However, there's always a risk that they could waste the money on bad investments or acquisitions. One thing that I would have loved to see in this report is where exactly they plan to use the $892.8 million in order to justify the dilution of the stock. Overall, QXO seems to be in a decent position, but their future success depends on how well they execute their plans with this new capital. What are your thoughts on QXO's stock sale? Do you think it was a smart move, or are there too many risks involved? Share your opinions in the comments below. If you found this analysis helpful, please hit the like button and subscribe to Corporate Decoder for more insightful breakdowns of company filings. And don't forget to join our Discord community in the description below to discuss these topics with other investors. Thanks for watching, and I'll see you in the next video.